Liquidity is crucial to the price of crypto, so understanding macroeconomics is becoming more important. Typically, the asset market usually moves in sync with the crypto market, while interest rates and the USD index tend to move in the opposite direction. High inflation doesn't have a clear correlation with the crypto market, but can lead to a drop due to fears of economic tightening. So just by analyzing macroeconomic factors, you can better predict market cycles and make smarter investment decisions. That said, the traditional approach mainly applies to coins like Bitcoin and Ethereum. After all, TradFi money isn't interested in meme coins or joke tokens where we find funny on the internet, right? So in this video, I'll analyze the macro in 5 different factors, and by the end, you'll understand how macroeconomic impacts the price of crypto and why I'm so bullish on the outlook of 2024 and 2025. If you like this type of analysis, let me know by commenting down below and we'll be sure making more in the future. With that out of the way, let's get started. First thing first, let's talk about interest rates. We have been dealing with high rates for a while now, so it's pretty obvious that they can only go down in the coming months. But why do we care about interest rates so much? Because they directly affect the money supply in the market. Usually, when the central bank lowers interest rates, it positively impacts the crypto market. This is because borrowing becomes cheaper, so people feel more comfortable taking risks and might allocate some money to cryptocurrencies. On the flip side, when rates go up, it hurts the crypto market because borrowing is now expensive and people have to be more cautious with their spending. And this theory has been proven to work perfectly well when COVID hit. There was so much uncertainty in the market, and both the crypto market and the stock market crashed. We were basically at a tiny recession for a month and a half. In response to this, the Fed took action and printed more than $3 trillion in 2020 alone and lowered interest rate to 0%. This triggered a much higher spending in the economy, including crypto investors. Just take a look at this chart on 15th of March 2020. The Fed made the announcement of QE to support the economy and went on a parabolic move, pumped over 800% before its massive correction in April 2021. However, the 2-year parabolic move wasn't without a cause. In 2020, inflation got so out of control that the Fed had to hike interest rates significantly to slow down the economy, making people feel like they're broke basically. This brings us to where we are today. Interest rates at a 23-year high, but with rates likely to go down in coming months. The best days for crypto investors are just around the corner. That said, I can't predict exactly when the Fed will lower rates, but my guess is Q4 this year, and to learn why, you need to hear my second reason for this bull case. My second bullish factor relates to interest rates too, but this time is Europe taking the lead. They've even jumped ahead of the Fed in cutting rates. After holding steady for 9 months, the European Central Bank, ECB, has cut the deposit rate to 3.75% from 4%, as the inflation rate is already around 2.6%, which is lower than the one in the US. You might find it hard to believe considering Europe had double-digit inflation in 2020, which was much higher than the US one, right? Well, that's true, but here's the thing. The US and EU have faced inflation for very different reasons. For Europe, it was mainly due to disruptions in energy supplies and the global economic recovery from the COVID pandemic. On the other hand, the Federal Reserve is dealing with an economic landscape influenced by inflation from government recovery spending and strong growth, which could mean the US inflation might be more persistent than we thought. But you could argue, Jemmy, isn't the inflation target 2%, so technically Europe is still not on track then, right? Well, that's true too, but despite the effort of rate hike for almost 2 years, domestic price pressures remain strong as wage growth is elevated and inflation is likely to stay above target well into next year in 2025. In other words, the EU is just accepting that 3% is the new 2%. And it's not just Europe cutting rates. Countries like Switzerland, Mexico, Brazil, Czech Republic, and Canada have already cut rates this year. Everyone is so eager to get the money printers going. Liquidity is starting to take up, not just in the US but globally, so a massive bull run is inevitable. Next up, we're also gonna look at the labor market for our macro analysis. For this, I'm gonna use the job data in May as an example. The US employment market stays strong in May, with the government reporting 272,000 new jobs, far exceeding estimates of 185,000 and well ahead of April's revised figure of 165,000. But however, if you actually dig deeper, you will see that full-time employment actually fell 625,000. Meanwhile, part-time employment rose by 286,000 and the unemployment rate climbed to 4%. This marks the biggest drop in full-time employment since December 2023 and the first time unemployment has been above 4% since February 2022. So question, why does it matter to crypto? This metric is crucial because rising unemployment gives the Fed less reason to keep rates high. However, since the headline job additions send mixed signals, it's hard to predict if the Fed will lower rates as soon as Q3 this year. To further build on this, we'll have to look at the oil market next. Oil is the most important commodity in the world, and its price can indicate where the global economy is headed. Like any asset, its price can be volatile. Remember during COVID when oil price went negative? Yeah, people were paying others to take their oil off their hands because storage was so limited. Fast forward to today, oil hit a 4-month low despite OPEC cutting the supply. Saudi Arabia, now part of BRICS, aimed to pressure the West by reducing world oil supply. But unexpectedly, the US ramped up its oil production, forcing OPEC to promise more supply starting in October. But this all of a sudden led to an oversupply situation, causing oil price to drop further. If there's suddenly so much supply, who's buying it, right? This caused some to worry that this as an early sign of recession, and that's really the case. The Fed might lower rates to counteract it. You might be like, why not just buy oil and store it to prevent loss of value? Well, because storing crude oil in above ground tanks is costly and tricky because oil can lose its viscosity. According to Reuters, the optimal storage period is between 30 days and 6 months. Not to mention, you need large space to build all those tanks, so if you think about it, that's not very economical neither. Well, I could do an entire episode about oil, but to summarize, when oil price keeps dropping, which signal a possible recession, the Fed would likely to cut rates to try to prevent that. And to top it off, it's also an election year. Fiscal policy often loosens during presidential election years, and history might repeat itself with bipartisan tax deal in the House of Representatives from February. This tax bill, while revenue neutral over 10 years, is highly front-loaded and expected to boost real GDP growth by roughly 0.1% in 2024 and 2025. Not only is the US presidential election, but EU having parliament election and UK having a general election in second half of this year. So with all these big events in the world's largest economies, what do you think will happen to the price of crypto? So Goldman Sachs research analyzed over 1,100 elections in 150 developed and emerging markets. They found that primary fiscal balance elections as a share of GDP declined by about 0.4 percentage points in election years due to spending increases and revenue declines. These effects tend to linger into the following year before fading after 2 years. In other words, politicians are willing to do or say whatever voters want to hear to win the election, including easing fiscal policy to boost the economy and spending more money to keep everyone happy. That said, each country is different and it depends on the central bank's independence. Fiscal policy is more responsive to elections in countries with weaker institutions, while monetary policy is more responsive in places with less independent central banks. And that's not very surprising, is it? Alright, so that's a lot of information and I'm so proud of you if you made it this far in this video. We don't do a lot of macro analysis on this channel, so if you find this type of content helpful, let me know by commenting down below. In the meanwhile, if you also want more regular updates from me, make sure to follow me on Twitter and Instagram, and I'll see you guys in the next one.